Hi everybody, welcome back to the Dividend Stockpile channel. My name is Jeremy and I'm here to remind our dividend investors, don't sleep on dividend ETFs. So a lot of people shun ETFs for various reasons, whether it's the perception of the expense ratio not being worth it, the lack of personal control over the investment choices, or that a person thinks that they can do better, i.e. beat the market. These reasons hide the fact that many dividend ETFs perform just as good or even better than individual companies that, as dividend investors, we cherish. In the past, I fell into the trap of wanting to control my investments by choosing individual companies, feeling that I could do a better job deciding on which companies would be best over time without paying an investment management company to pick for me. I've since loosened my stance on having dividend ETFs in my portfolio. I now have a balanced approach to individual stocks and ETFs, allocating percentages, and as time goes on, I find myself drawn more and more to ETFs. As you see in the video popping up at the top of the screen, my goal of ETFs in my portfolio is now 65% of my holdings will be ETFs. No one knows the future. Even the pros have a hard time beating the index. A recent survey by S&P showed that 94% of investment professionals underperformed. So that means only 6% beat the market over the last 20 years, ending in 2021. Looking at other time periods down below, the number of funds underperforming their benchmarks on a 20-year basis is 94%, 10-year 83%, 5-year 74%, 3-year at 67%, and 1-year at 85%. So even the professionals can't do it, but to be honest, individual investors are really bad at beating the index too. Per a report by State Street Advisors in 2023, over the past decade, only 52% of the S&P 500 stocks on average have outperformed the index, and only 70% of stocks on average had any gains at all. Additionally, if you look at longer time periods, it's an older chart, but it shows that the S&P 500 over this time returned 8.2%, and a 60-40 portfolio of stocks and bonds has 7.2%. But the average investor over on the right only was able to manage a 2.1% annual increase. So, with all this being said, why do we as individual investors think that we can be in that top 6%? Beating the index for 1 or 2 years is possible, but over the long run, which is what we should be focused on, it is an extremely difficult feat to do. While it might be fun and exciting to research and pick individual companies, are we really making the best financial decision by doing so? So there's a solution, and it's to invest in a group of diversified ETFs. By investing in a diversified ETF, it has rules and metrics in place to remove and replace underperforming holdings that we let the self-cleansing nature of ETFs do the monitoring and decision-making for us. Do your individual holdings beat the mix of current dividend growth, and capital appreciation that the ETFs we're going to be discussing today produce? I know some of my individual holdings don't, some not even close. Are we really that confident that we make 100% good decisions with each holding, buying and selling as needed to outperform? So not all dividend ETFs are great, but there are some that are definitely top-notch and worthy of your consideration. Each ETF has different investing philosophy and methodology on how they select stocks, so take a look into each one to understand how they operate and if you agree with their process. In the following pages, we're going to be talking through some of the recent metrics from some of the higher and most popular ETFs for dividend investors. And one thing that's great about these funds is they provide consistency and diversification. So as you will see, some of these funds hold hundreds of different companies, and they are more stable when it comes to their returns and dividend growth than individual companies might be. They also provide stable dividends and dividend growth. So that's what we're all here for, is the income. And so by receiving a stable dividend that rarely gets cut over time and providing dividend growth to beat out inflation and grow our accounts, it's a perfect balance of having the growth and stability that you are looking for as an investor. So let's start talking through some of the ETFs that I will present here. The first one is DGRO. DGRO is iShares Core Dividend Growth ETF. It seeks to track the investment results of the Morningstar US Dividend Growth Index. That index is designed to provide exposure to securities in the Morningstar US Markets Index that have a history of uninterrupted dividend growth and the capacity to sustain that growth over time. Some of the fun details, this is run by iShares, which is one of BlackRock's products. The inception is June of 2014, and the current expense ratio is 0.08% a year, and assets under management is just at $25 billion. Looking at the individual sectors, you see that financial and technology and healthcare are the top sectors in this fund, followed by industrials, consumer defensive, energy, and then consumer cyclical, utilities, basic materials, and communication rounded out. The top 10 holdings include Microsoft, JP Morgan Chase, and Johnson & Johnson. And as you see at the bottom, they hold 424 holdings, and the top 10 only represent 26.75%. So because they hold so many holdings, each individual company is not a large percent of the portfolio, which gives you the stability and diversification that you expect from an ETF. On the dividend side, the current yield is 2.45%, and their 5-year dividend growth rate is 10.18%. So if anyone's researched the Chowder rule, it says that the current dividend plus the 5-year dividend growth rate on an investment should be over 12. So looking at DGRO, it does hit that metric, coming in at about 12.5, 12.6. So that is a really good combination of current yield and dividend growth. They've been growing their dividend for the last 9 years since they were established, and they do pay on a quarterly basis. Looking on the right, you can see the dividend growth history has been growing over time, just as we would expect, and has what we would need for our investment. Looking at the performance, the 1-year total return of this particular ETF is 9.51%. 3 years is a total of 26.25%, and 5 years, a very respectable 73.25%. Going over to Portfolio Visualizer, if you had a $10,000 initial balance, that balance would be $25,191 today for a 10.81% compound annual growth rate. The worst year was only negative 7.90%, and the best year was almost 30%. I like to see an ETF that doesn't have a lot of downside because it's a lot easier to stomach a small downturn as opposed to some of the other funds and individual companies that could sometimes have 50, 60, or 70% years. The max drawdown from peak to trough on this particular ETF is around 22%. Okay, dividend ETF number 2 is VYM. VYM is Vanguard's High Dividend Yield Index Fund. It seeks to track the performance of the FTSE High Dividend Yield Index that measures the investment return of common stocks of companies that are characterized by high dividend yield. It is designed to represent the performance of companies with relatively high forecasted dividend yields. It started by Vanguard, of course, and it started in 2006 and has a very low expense ratio of 0.06% a year. Assets under management is much larger at $63.11 billion. Looking at the holdings breakdown, you see that financials are the largest position by far, followed by consumer defensive, healthcare, and industrials. Technology is about 11%, and then you have energy, consumer cyclical, utilities, communication, basic materials, and a very tiny little bit of real estate. Looking at the top 10 holders, you can see it's more diverse than the one we just saw. In the different sectors, we have JP Morgan Chase, Broadcom, Exxon, Johnson & Johnson, Home Depot, Procter & Gamble, Merck, AbbVie, Chevron, and Pepsi. The top 10 represent just under 25%, and it has 452 total holdings as of the end of last year. For the dividend stats, the current yield is 3.15%, which is higher than our previous ETF, but it does have a lower 5-year growth rate of only 5.59%. So in this case, it does not meet the Chowder rule that we had discussed earlier. It has 13 years of growth, and it does pay a quarterly dividend. If you look over on the right-hand side, you can see the dividends have increased over time, but the rate of change is lower than what we saw in the previous one. The performance for the 1 year in this fund is 5.06, 3-year at 28%, 5-year at 57%, and this one has been around for over 10 years, so it's 144.89% total return over the last 10 years. Again, going to Portfolio Visualizer, an initial $10,000 would be worth $36,705 today, for a total compound annual growth of 7.95%. But this one has higher volatility, with the best year at 30% and the worst year at 31.91%. And the max drawdown from peak to trough was almost 52%. So this one hasn't performed quite as well as the previous one. But at the end of the session, we're going to compare all four together. The next one that we're going to talk about is NOBL. NOBL is the ProShares S&P 500 Dividend Aristocrats ETF. It seeks to track the performance of the S&P 500 Dividend Aristocrats Index. And they measure the performance of S&P 500 companies that have increased their dividends every year for at least the last 25 consecutive years. This particular fund is run by ProShares, and it was started in October of 2013 and has an expense ratio of 0.35%. So it's much higher than the other two we mentioned. So that is something to take into consideration. And the total assets is about $11.5 billion. As you can see by the holdings breakdown, the sectors, the highest one is consumer defensive, industrials, and then way below that is healthcare, financials, and basic materials, consumer cyclical, real estate, utilities, technology at 3.17%, which is the lowest of the ones we've seen so far, and energy wrapping it up with 2.47%. The top 10 holdings is very diverse, as Sherwin-Williams, Target, S&P Global, Ecolab, Grainger, Franklin Resources, IBM, A.O. Smith, Abbott Laboratories, and Medtronics. It only holds 69 holdings in this account because there's only 69 dividend aristocrats. So the total of the top 10 is only 16.76%. So this is the most diversified and lowest percentage of each individual holding of the ones we've looked at yet. Some dividends, the current dividend is 2.13% with a 5-year dividend growth rate of 6.78%. And as you see, this only has 1 year of dividend growth. So looking at 2022, the total dividends paid out was actually a little bit lower than 2021. But as you see in 2023, it bounced right back up and it beat out 2021. So it's definitely on the right path, but it's a little bit lumpy when it comes to the dividend growth. It is a quarterly payer, paying out in the months March, June, September, and December. The total performance is reasonably well. The 1 year is 4.98, and you'll see between all the dividend companies and dividend ETFs over the last year, it has been quite hard on them. With the rising interest rates, it provides investors alternatives to dividend payers, including T-bills and short-term CDs. So they've had a rough go, but at 3 years is at 23%, 5 years at 64%, and 10 years at 163%. So over the long run, it's done extremely well. Again, looking at Portfolio Visualizer, a $10,000 investment would be worth $26,000 today for a compound annual growth rate of 10.14%. This is a much more stable fund than the one we talked about earlier. The worst year was only negative 6.51, and the max drawdown from peak to trough is only 23%. So you do get a much more stable ride, but the dividend and dividend growth is a little lower than the other funds we've looked at so far. Okay, moving on to dividend ETF number 4 is all of our favorite SCHD. So SCHD is the Schwab US Dividend Equity ETF, and it seeks to track the performance of the Dow Jones US Dividend 100 Index. And this index is designed to measure the performance of high dividend yielding stocks in the United States with a record of consistently paying dividends, and further selected for their fundamental strength relative to their peers based on financial ratios. The fund is run by Schwab. It was started in October of 2011 and has a very low expense ratio of 0.06% and almost $52 billion worth of assets. Looking at the different sectors, industrial leads the group, followed closely by healthcare and financials. Technology is 12.72%, and then consumer defensive is at 12%, and all the other ones are under 10%. You will notice that there are no real estate holdings in this particular fund, and utilities are almost non-existent as well. Looking at the top 10 holdings is quite diverse, though. You have Broadcom at number 1, AbbVie, Merck, Home Depot, Amgen, Texas Instruments, Cisco, Coca-Cola, Verizon, and Pepsi. All holdings that, as dividend investors, you'd be happy to hold them individually, but this way in the ETF, they do it for you, and they do compare the companies based on their relative strength and other financial ratios to make sure that they are quality investments. This particular fund holds 104 different holdings, and their goal is that no individual holding is more than 4% when they do their quarterly rebalancing. So the ones that are over 4% today, a little bit will be sold to balance it back out to that 4% max. And this provides diversification and making sure that no single investment gets too large in the portfolio. Looking at some dividend stats, has a good solid yield of 3.51% with a 5-year dividend growth of 13%. So this one knocks the socks off all the other funds when it comes to their dividend growth. Also, the current yield is one of the highest out there as well. They've been growing dividends ever since they started 12 years ago, and it does pay quarterly again in March, June, September, and December. Looking at the dividend growth history, you can see quite the increase over the last few years. Starting in 2023 all the way up to 2013 all the way up to 2023. It's a nice consistent rise up and to the left. Okay, looking at total performance, again, as the other dividend ETFs showed, this 1-year return is only 3.75%, but the 3 years at 27, 5 years at 82, and 10 years at a whopping 186%. Looking at Portfolio Visualizer, a $10,000 initial investment would be worth $42,000 today for a compound annual growth of the total return of 12.74%, with the worst year only being negative 5.56% and the best year being almost 33%. The max drawdown, again peak to trough, was 21.54%. So this gives you excellent current yield, excellent dividend growth, and capital appreciation over time, and more stable than other companies and other ETFs out there. So let's do a quick side-by-side comparison of the 4 funds we talked about today. So you see we have the iShares Core Dividend Growth, Vanguard High Dividend Yield, ProShares S&P 500 Dividend Aristocrats, and the Schwab US Dividend Equity ETF. So of the 4, the Schwab has the best final balance, as well as the best compound annual growth rate of 11%. And it has the lowest drawdown of negative 5.56% and the lowest max drawdown. So depending on your needs, you could pick one or more of these, but by the looks of it, the Schwab US Dividend ETF, SCHD, has historically beat out the rest. And then doing a comparison from when the newest fund was started, which was June of 2014, went ahead and did a chart of all 4 total return. And so as you see, DGRO beats when it comes to the total return at 121%, followed by NOBL at 110%, SCHD at 103.5%, and VYM trailing significantly behind in blue at 71.17%. So final thoughts on this video is that you should not sleep on dividend ETFs. They can provide the stability that you need without having to do all the research on individual companies. Do we really have the time and expertise to analyze 20, 30, 40 companies that would require to have a properly diversified portfolio? Probably not. My feeling is there's a lot of speculation out there and people don't truly know what they have. But by using dividend ETFs, you can put that on the index or the advisors who are running the fund to make those decisions for you. And as they identify companies that aren't doing as well, they can swap those out and replace them with other companies, all while doing it for you, and you don't have to do any of the legwork. So thank you for watching. Really appreciate your time. While you're here, please click on the video appearing on your screen. And if you haven't already, please subscribe, click the bell notification, and like this video and share it with friends. If you want more information, you can visit us on dividendstockpile.com, or you can reach out on X at divstockpile. Thank you again. Look forward to talking to you in our next video.